Most investors focus only on returns, assuming that the money they make in the market is theirs to keep. But the reality is far more complicated. Hidden costs silently eat into your gains year after year. Fees, taxes, and inefficiencies can turn what looks like a winning portfolio into mediocre performance. Many investors never notice until it's too late, believing they're earning more than they actually are. Today, we'll uncover the real costs of investing, why they matter more than most people think, and how you can take control to protect and grow your wealth. By the end of this video, you'll understand exactly where your money is leaking and what steps to take to stop it. What about management fees and expense ratios? Every mutual fund, ETF, and advisory account comes with management fees. These are charged as a percentage of your investment annually. Even a seemingly small 0.5% or 1% fee can compound into tens or hundreds of thousands of dollars over decades. Many investors underestimate the cumulative effect of these fees, especially on long-term growth. High-cost funds often underperform low-cost alternatives over time, even if their past returns appear impressive. Understanding what you're paying for is essential because fees are guaranteed costs, while returns are uncertain. Reducing fees is one of the simplest ways to improve your portfolio's performance without taking more risk. Monitoring your expense ratios regularly helps you spot any creeping costs. Switching to lower fee alternatives may seem minor at first, but can dramatically boost wealth over time. Transparency in fees gives you control over where your money goes. Being proactive ensures you're not silently losing profits every year. 2. Trading costs and commissions. Every trade you make comes with a price. Even with zero commission platforms, there are hidden spreads, bid-ask costs, and occasional platform fees. Frequent trading, especially in active accounts or swing trading strategies, can drastically reduce return. Many investors fail to account for these small costs, but over years of trading, they accumulate and become significant. Learning to minimize unnecessary trades and choosing low-cost brokers can dramatically improve net return. Avoiding impulsive trading decisions not only reduces costs, but also improves your overall investment discipline. Each unnecessary trade chips away at long-term gains. Being mindful of trading frequency and strategy is as important as choosing the right asset. Automated investing tools can help reduce human error and excessive trading. Discipline in trading ensures your portfolio grows efficiently without hidden friction. 3. Taxes on gains and dividends. Taxes are a silent killer of investment returns. Short-term capital gains are often taxed at your ordinary income rate, which can be much higher than long-term rates. Dividends, interest income, and certain mutual fund distributions are also taxable, reducing the net benefit of your investment. Many investors don't plan around taxes and end up paying more than necessary. Strategies like tax loss harvesting, using retirement accounts, and holding investments long-term can significantly reduce your tax burden. Being proactive about taxes allows your portfolio to grow faster without additional contributions. Ignoring taxes can turn a profitable strategy into a marginal one. Understanding tax brackets, timing sales, and reinvesting dividends intelligently is crucial. Taxes compound quietly, just like returns, and can erode significant wealth if neglected. Proper tax planning ensures that you keep more of what you earn. 4. Inflation, the hidden drag on returns. Even if your portfolio grows, inflation reduces your real purchasing power. If your investments earn 6% per year but inflation is 3%, your real growth is only 3%. Many investors focus on nominal returns without considering inflation, giving them a false sense of security. Over decades, inflation can erode the value of savings and retirement funds if not accounted for. Asset allocation, investing in inflation-protected securities, and diversification into real assets like commodities or real estate can help mitigate inflation risk. Understanding this invisible cost is crucial for long-term wealth preservation. Inflation affects every asset differently, and some investments may not keep up at all. Including assets that hedge inflation protects your purchasing power for decades. Ignoring inflation can turn a seemingly successful portfolio into underperformance. Planning for inflation ensures your money grows in real terms, not just on paper. 5. Opportunity costs. Investing in the wrong asset, timing the market poorly, or holding cash unnecessarily creates opportunity costs. Every dollar tied up in a low-performing asset is a dollar that could have earned more elsewhere. Many investors are unaware of how much potential return they're leaving on the table. Opportunity costs are subtle but accumulate over time, often surpassing explicit fees or taxes. Comparing performance against benchmarks and staying disciplined with your allocation can reduce these hidden losses. Effective portfolio planning ensures that your money is always working as efficiently as possible. Opportunity costs also include time spent in indecision or procrastination. Shifting capital into higher-performing sectors strategically maximizes your long-term growth. Every missed opportunity quietly reduces your portfolio's potential. Awareness of opportunity costs keeps your investment plan proactive instead of reactive. 6. Behavioral costs. Emotional investing. Your own psychology can cost more than fees or taxes. Panic selling during downturns, chasing hot stocks, or overtrading erodes returns over time. Behavioral mistakes are common and often amplified by market volatility. Even long-term investors sometimes act impulsively, undermining their disciplined strategies. Recognizing emotional triggers and sticking to a well-thought-out plan is one of the most effective ways to reduce these hidden costs. Building habits like pre-planned rebalancing and avoiding reactive trades strengthens returns while reducing stress. Stress-driven decisions often lead to costly mistakes. Emotional discipline separates successful investors from those who lose capital unnecessarily. Using automated contributions and systematic investing reduces the impact of emotion. Learning from past behavioral errors improves decisions for future market cycles. 7. How to minimize hidden costs. The good news is these hidden costs can be reduced with planning and awareness. Choose low-cost funds and ETFs over high-fee alternatives. Take advantage of tax-advantaged accounts like IRAs, 401ks, and Roth accounts. Minimize unnecessary trades and practice long-term investing. Rebalance strategically, not impulsively, and consider assets that hedge inflation. Educating yourself about these invisible drains empowers you to make smarter decisions that directly improve net return. Over time, small improvements compound into significant wealth advantages. Regularly reviewing your portfolio ensures fees, taxes, and trading habits remain optimal. Proactive cost management allows more capital to compound, boosting total returns. Strategic planning turns minor savings into major long-term wealth gains. Efficiency and awareness create a disciplined, cost-effective investment approach. 8. The impact of costs. Over time, even a 1% annual cost difference may seem small, but over decades it can reduce wealth by hundreds of thousands or even millions of dollars. Investors often focus on gross returns, but forget that net returns, after fees, taxes, and inflation, are what really matter. By understanding all the hidden costs and actively managing them, you can dramatically improve long-term results. Awareness transforms your approach to investing from reactive to strategic, giving you more control over your financial destiny. Compounding works best when costs are minimized and efficiency is maximized. Small savings on fees, taxes, and trading costs compound into massive differences over decades. Ignoring these costs is like watching money slowly leak out of your portfolio. Managing these costs ensures your returns reflect the true potential of your investment. Every little improvement adds up to substantial gains over time. Long-term wealth isn't just about returns, it's about keeping as much as possible of what you earn. If this video helped you understand the hidden costs silently eating your investment returns, take action now. Review your current portfolio for high fees, unnecessary trades, tax inefficiencies, and underperforming assets. Make adjustments gradually and consistently to protect and grow your wealth over time. Share this video with someone who thinks all gains are theirs to keep. Subscribe for more actionable investing insights. And hit like to support content that empowers smarter decisions. Take a few minutes today to identify where your money is leaking and create a plan to stop it. Track your progress and revisit your portfolio regularly to ensure it stays optimized. Minimizing hidden costs compounds into massive long-term wealth advantages. The money you save today strengthens your financial future and brings you closer to financial freedom. Don't wait. Start implementing these strategies now and watch your wealth grow efficiently over time.